Good afternoon. Welcome to the TheoTrade evening video. I'm Blake Young. Today is February 13th, 2023. And today we're going to discuss, will CPI break this rally? We've had a strong rally that started weeks ago. Arguably, you could even go back into October and look at the massive low and the super higher highs, higher lows that created an uptrend, and the bigger pattern that created lows, highs, and lows, and a rally right into where sellers were last August. So is CPI going to be the catalyst to turn this around? Are we going to see CPI data cause the market to continue to run or fade? And to look at that, we got to dig a little bit deeper into the CPI data. As a side note, CPI, Consumer Price Index, is the measurement of how much things cost consumers. The reason why people like this indicator is because consumers account for 60 to 65% of the entire GDP. If inflation prices are really high, then costs go higher and higher for consumers, and therefore they start spending less on things because they can't afford as many things, which means high inflation means less spending, which in turn will indicate lower GDP or lower production, which can lead to a recession. So CPI is focused on a lot. Realistically, the Fed likes to use PCE, personal consumption and expenditure, more than CPI, but we still have a significant impact from CPI and a focus on CPI by investors. Today's move was right in line with what we'd expect. CPI is coming up and investors keep pricing in a pause. They keep pricing in the Fed pivoting, and if they're not pivoting, like I said, at least a pause in rate hikes. Well, the rate hikes are still going to happen. As we're looking at SPX, we're looking at climbing. We need to dig into that CPI data to understand what we're seeing and what that means. So I'm going to show you a couple of different places. We'll show you Forex Factory. I do like their little charts over here on the right-hand side. You'll see we have month to month and year over year. The anticipation for this month is that we're going to see a slowdown on the year to year and an increase in the month to month. And the question is, why does that happen? A slowdown in the year to year of 0.3% and an increase of 0.6, that would infer that if we're accelerating in the last month but declining in the last year, that we're cutting off 1 month that was higher than our average. That's really all it means. If we look at a little bit closer to this, and we can look at this chart, I'm going to show you the year to year. The year to year you can see is fading and fading and fading, and that is an indication of slowdown. But still, we're at 6.5%, and even if we do go to 6.2%, 6.2% will only match what we had in November of 2021, which means we're still at the same overpriced products, food especially, and inflation remains high. With inflation remaining high and the highest levels we've been at in decades and the highest levels we've been at that last number of years, what's causing this? It's simply math. All we're seeing is dropping off the previous month. Let me show you what's really going on. If we're increasing by 0.5, then we look back and we're saying we are showing 1 year. And if we're showing 1 year, we should be able to go back into the month to month, and we should be able to look back a year ago and say, what are we dropping off? And if we go back into the previous year, saying that we're dropping off December, there's your December rate, and it is 0.8. What do you know? There's our number. If we take 0.8 that we're dropping off, we're just not counting it anymore because it's 12 months ago, 13 months ago. We're dropping off the 13th month and we're adding a 0.5. So the net difference between 0.8 and 0.5 is 0.3. Hence the reason we think we're going to go from 6.5% to 6.2%. Oversimplification, I know, but that's really what is going on. We are not truly slowing down. It's more that we are just kicking off the highest 2 months last year. What we're going to see is this is going to drop down here, and we're not going to see the March report from February, so next month's CPI report. We will likely not see a decline. Why? Because we're going to drop off a 0.5, we're going to add on a 0.5, and if there's any other inflation, if we look at energy prices, they're up, so we will probably not see a drop in March. Therefore, regardless of how we respond, we are going to price in higher inflation in March. We're just not pricing it in now. So let's take a look at the BLS, Bureau of Labor and Statistics. That's the main site. You'll be able to see it numerically there. And we'll highlight a couple of different numbers here. This is on Bureau of Labor and Statistics, their CPI data. This is last month. We're looking at the last month, December's report, which reported in January. We're now tomorrow going to report January's report, reported in February. And you can see there's the unadjusted 12-month average, 6.5%. But do you see that food and food away, meaning at home and at restaurants, is still double digits, 10 and 11%. We look down here, fuel oil, 41%. Add that to energy services, 15%, and electricity, 14%. Utilities, as in gas, liquid gas products, 19.3%. And so the only thing we're seeing drop of any significance is used cars and trucks. We talked about this last month. This is not a good judgment of whether we should see deflation or disinflation. Gasoline is down 1% last year, but is that going to be the same thing? Let's take a look at retail gas prices here in just a minute, but I want to highlight once again what we're doing is we're just dropping off the November 0.8, the December 0.8, and so as we keep dropping off these big numbers, as we get into January, February, and report that this year, these numbers are not as big of a drop-off from CPI, and therefore we will likely see year-over-year CPI go up in March. Gasoline prices were down negative 1.5% in December. If we were to look at January and assume that retail gas futures are roughly the measurement, were we down or up for January? So here's January price action. We opened here, dropped down, spiked up, and we go to December or February, and we're pretty flat for January. I don't see us seeing a negative number here. And if we put in DBA, Deutsche Bank's agricultural products, can be a substitute for prices for food. And if we look at January again, here's January 3rd, first day of January here. We dropped all the way down, recovered all the way up, and this is January 31st or February 1st, and we're slightly up. If we want to take a percentage on that, we were already seeing significant moves up and double digits in food, but now we're talking about an extra 0.5, 0.58, 0.3 for January. So the numbers look to be that we're going to have maybe a less of a drop year over year, maybe a larger increase for January, but we are already setting up for a bigger move for February's prices. If we look at February's prices, here's the first trading day of February, we're already above that. If we continue moving higher in February, we're already seeing a 0.5% increase in the first half of the month. If this continues, food prices could go up another 1%. It could be that we see food prices inflation data showing 11 and 11.5% for March's report. Now, I know we're not worried about March's report right now. We're worried about February's report, the one we're going to see tomorrow. And that's the question. Will CPI surprise us? Will we not have the pullback to 6.2%, even though that's flawed? Will we see higher CPI and therefore higher anticipation of a Fed rate hike? Looking at the CME watch tool, this is what we're looking at across the board, saying what is the CME pricing in as far as the Fed rate hikes. Now, as we're looking at this is not until March, but it has a 90.8% probability of a 25 basis point hike. And if you remember last week, a week ago Wednesday, we talked about that there was actually some anticipation of a rate cut starting to be priced in, but we're back to a 90.8% probability of a 25 basis point hike and about a 10% probability of a 50 basis point hike in March. We're not talking about a cut. We're not talking about a pause. We're talking about more rate hikes. If CPI comes in any higher than 6.2% for the year, any higher than 0.5% for the month, I believe we will be pricing in 95, 98% probability here, or we might only be pricing 80% here and possibly 20% of a 50 basis point hike. We saw the European Central Bank and the Bank of England raise rates by 50 basis points. The US only did 25 basis points. We are still seeing inflation. There is still room to raise rates. Now, as we're looking at this, the market still is pricing in bullishness. They're pricing in climbing equities, which is not pricing in rate hike. In fact, XLK had a very, very bullish day. This is likely going to be our overnight or first thing on the market open high. If we look at this level, the high is here and the low is here. This range, this consolidation, if I were to look backwards and look at where this lines up, is this a key data point that would tie back to previous inflation reports? Is this a key data point as far as barriers, buyers and sellers? And why are we rallying so aggressively in technology if we're going to see further rate hikes? The way I see this is this move from here to these highs, that's an 18% increase. Or if you want to go from the lows that we had for the year, 26% increase. Where are the interest rates in conjunction with what we're seeing in technology? Let's take a look at the TNX. The TNX bounced down today. This is that pricing in of inflation. We're not seeing as much inflation. We're seeing a slowdown, at least what the analysts are predicting. We're coming in at 6.2%, and the bounce down in yields is part of that anticipation. If the inflation's in check, if inflation's slowing down, then we are not needing more rate hikes. And so the rate hikes anticipation moved down a little bit, at least in the 10-year Treasury. But as I look at this, the 10-year Treasury created a double bottom, reversed off of that low, broke out, and is retesting that price action. These areas up here are reasonable. And a move up to 3.8%, what were we seeing the very last days in December? In fact, if we break through this level and create a massive rectangle or even larger double bottom, we could go from 3.4 to 3.9. That's percentage. These read as 10 times that because it's a 10-year Treasury. But if we break through the 39, then we could go $5 more, if not more, and go all the way back up to 4.3. Keep this in mind if we were to compare the two, that the two of these generally move opposite of each other. There's sometimes a little bit of a lag creating this low and this higher low, while this created a low and a lower high. So there'll sometimes be a lag in the technology, but these two generally move opposite of each other, find their peaks and valleys roughly within a day or two of each other, and are usually moving counter. But you'll notice that as yields have gone up, technology's gone higher. So the rest of the year, we're doing these opposite moves, opposite moves, opposite moves. And right now, we're seeing they're moving in lockstep. Again, this is one of those combinations or this is what I would consider a divergence across instruments, because normally these should move opposite. In fact, if we throw in the studies and instead of making a comparison, we do a correlation and type in correlation here and put in the TNX versus the XLK, the correlation we would expect would be an inverse correlation. And you can see we have the negative 1 to 1. That's the area we want to zoom in on. And we'd normally expect us to be below that 0% line. And below the 0% means inverse correlation. Therefore, when yields go up, then the technology sector should come down. You can see the majority of the time it is highly inverse. We have negative 85, we have negative 93, highly inverse. And so right now, this going into the positive territory is a divergence or a disconnect, a decoupling of that traditional historic inverse correlation. So similar to what we already talked about with bonds and the dollar and equities and gold, the correlations that we normally would expect to see, technology has an inverse correlation to yields. The fact that yields are rising and technology is rising, one of these is out of sync. If CPI comes in higher than expected, if we price in more rate hikes, then I believe technology, the purple line here, has to reverse and will likely reverse and erase most of this time frame, getting back to where we were in a positive or an inverse correlation and see prices drop back down aggressively to January's lows. And tomorrow could be the catalyst. Watch that number. If CPI comes in higher than 0.5 for the month, if CPI comes in less or greater than 6.2% for the year, then technology will likely adjust and adjust quickly. Because it's pre-market, it's an hour before the market opens, you may have to look to the Nasdaq as a good substitute to trade technology short if this is the top in the market. It has to have higher inflation. Now, if we get surprised to the downside, well, we're already pricing in low inflation rates. And so if we get a downward surprise, then this bull flag appears and we break out and shoot higher. If it's higher than anticipated, then we reverse here and we fall back, possibly all the way back down to 11,400. Tomorrow could stop this rally. Then again, if it's super slow, if the CPI drops down, if we're sub 6%, then onward and upward. So those are the things to watch for. There's a lot of things going on tomorrow. Be careful. Watch the numbers. Be really quick to adjust and reduce risk. And be very aware that this is not just about inflation. This is about interest rates and forward projection growth for the year. Have a great night, and we'll look forward to talking to you again later.